Hi, I'm Charisse Ang and I will be tackling stock repurchases. So first of all, what are stock repurchases? Stock repurchases are also known as stock buybacks. These are transactions wherein a firm buys back shares of its own stock. And these stock that were purchased are called treasury stock. There are three principal types of stock repurchases. First is when a firm has extra cash available for distribution to shareholders, so they repurchase shares to distribute the cash rather than pay cash dividends. Why? Because through this, stockholders can have a choice to sell or not to sell, and also because repurchasing sends positive signals to investors that the firm believes its stock is undervalued. Second, when a firm concludes that its capital structure is heavily weighted on equity, it repurchases to gain a more optimal capital structure. For example, when a firm uses cash to repurchase, its assets is decreased and subsequently its equity. And third, when employees exercise options issued to them by a firm, the firm repurchases its stocks to avoid dilution or the reduction in percentage equity ownership of a company due to additional equity being issued to other owners. So, what are the usual effects of stock repurchases? Primarily, it decreases shares outstanding, which refers to a company's stock currently held by all its stockholders. Next, it increases EPS given the same net income. Take note of the following scenario. Kindly pause and read. In this example, we get the EPS and PE ratios before purchasing as shown in the table. Because of the 110,000 shares repurchased by ADC, shares outstanding decreased, thus resulting to a higher EPS of $4.44. Now, we can see here that ADC's stock price stayed at $20 per share, causing PE ratio to decrease. One possible reason may be because of an increased debt ratio, which makes a stock riskier for the shareholders. Some advantages of stock repurchases are the following. Repurchases are perceived as a positive signal as it implies that management believes the firm's shares are undervalued. Second, it gives stockholders the choice to sell or not, so those needing cash can sell while those who do not can get cash dividends, but pay for the higher income tax rates compared to capital gains tax. Third, it removes the large block of stock that keeps price per share down. Fourth, it is advantageous for companies that are reluctant to raise dividends expecting that the increased cash flow cannot be maintained. These companies would rather repurchase than cut cash dividends, which gives a negative signal to investors. Fifth, companies can utilize the residual dividend model in order to set a target cash distribution level to be divided into a dividend component and a repurchase component. This gives more flexibility to the company because repurchases can be varied without sending adverse signals. This way, the company avoids fluctuating dividends which may lower investor confidence. Sixth, repurchasing are utilized to produce large-scale changes in a company's capital structure, like borrowing to increase debt or using cash to decrease assets, and in turn, decrease equity, sometimes to minimize WACC. Repurchasing allows the company to avoid having to issue new shares for when employees exercise their options. This avoids diluting EPS from issuing new shares. Now, for the disadvantages of stock repurchases. First, stock prices might benefit more from cash dividends than from repurchases, since they are more dependable in signaling a company's confidence on its future cash flows. Second, selling stockholders may be at a disadvantage from not having all the information on a company's present and future activities, especially when management is repurchasing because it believes its stock price is well below its intrinsic value. Third, companies may end up repurchasing their stock at a very high price and then fall after the repurchasing, which is disadvantageous for the remaining stockholders. Now let's try some problems. Please pause the video to read. So the problem is to determine Gamma Industries' stock price after the repurchase. The given data are the following. First, we find EPS and PE ratio before the repurchase. For EPS, it's 3.8 million over 1.49 million, which results to $2.55 per share, while for PE ratio, it's 67 over 2.55 or 26.2745. Since we know that repurchasing affects EPS because it decreases shares outstanding and that it had no effect on net income and PE ratio, we can use EPS and PE ratio to find the stock price after repurchasing. The computation is as follows. EPS will be equal to 3.8 million over 1.341 million or $2.83 per share. This will be used in the PE ratio to find the new stock price. Using the previous PE ratio and new EPS, we have a result of $74.44 for the stock price. For the next problem, we have to determine how much external equity Coastal Carolina needs. The given data are the following. First, we find the retained earning, which is net income less the dividends to be distributed, which equals to $2.25 million. Next, we find the total equity required for the investment by subtracting the debt required from the cost of the investment, and that is equal to $13 million. Finally, we can now determine the external equity required by subtracting the internal equity, or the retained earnings we computed to the total equity, and that results to $10.75 million. For the last problem, we will determine Keenan Company's total dividends for 2018 following the indicated. First, we find the dividend payout ratio from 2017's data, which will actually result to 1/3 or 33.33% as shown on screen. Multiplying this with 2018's net income, we get $4.8 million as the year's regular dividends. Next, we find the residual dividend by subtracting the portion of the investment to be funded by equity from 2018's net income, giving us a result of $9.36 million, with extra dividend equal to $4.56 million.